You are 31 years old, and you are doing everything right. You earn $94,000 a year. You have $41,000 sitting in a high-yield savings account earning 4.6%. You max your 401 class. You have no credit card debt. You split your rent with a roommate even though you could probably afford to live alone. Your credit score is 791. You have a spreadsheet that tracks your net worth to the dollar. Every financial influencer you follow would tell you that you are winning. You are not winning. You do not know this yet. The conversation that changes everything happens on a Wednesday, a casual dinner. Your college friend Marcus has just joined a family office as an analyst. He earns more than you. He does not say this. You know from the context. He orders without looking at the menu. You mention your savings account, not as a brag, just conversation. You say you've been watching the interest compound, that it finally feels like real money, that you're almost proud of it. Marcus sets down his glass. He does not say anything cruel. He does not lecture. He asks one question. He says, "What's inflation running right now?" You say, "Around 4%. He says, "And your account pays what?" 4.6. He is quiet for a moment. Then he says, "So you're netting 60 basis points before tax, on money that could be deployed." You say, "It's safe." He says, "Safe from what?" You do not have an answer. Not a real one. He says, "I'm not trying to make you feel bad. I just want to show you something." 6 weeks later, you are sitting in a conference room on the 34th floor of a building that does not have a name on the outside. Marcus's firm manages private wealth for 11 families. Combined, they hold over $4 billion in assets. None of it, not a meaningful dollar of it, is in a savings account. The woman presenting is named Renata Solis. She manages strategy for 3 of those families. She is not warm. She is precise. She pulls up a single slide, one number on it. The number is 47. She says, if you put $100,000 into a savings account in 2000 and earned average bank rates, you have roughly $147,000 today. That feels like a gain. She advances the slide. One more number. The number is 87. She says, inflation adjusted, that $147,000 buys you what $87,000 bought you in 2000. The room is quiet. She says, you didn't save money. You stored it somewhere that slowly ate it. This is the first thing you have to understand. A savings account does not preserve wealth. It converts wealth into the illusion of wealth. You see a number going up. You feel responsible. You feel safe. The number is, in real terms, shrinking. The average savings account in America pays 0.46% interest. Even a high-yield account, the ones marketed aggressively as revolutionary, pays between 4 and 5% in a high-rate environment. When rates fall, they follow. They always follow. Inflation does not follow. Inflation does not care about your rate environment. Over the last 30 years, inflation has averaged 2.9% annually. Over the last 5 years, it averaged 5.3%. The gap between what a savings account pays and what inflation takes is not theoretical. It is permanent, quiet, and compounding in the wrong direction. Renata says, every year your money sits in a savings account, you are making a decision. You just don't feel like you're making it. The second thing takes longer to understand. Renata introduces you to a concept the firm calls deployment velocity. The idea is simple. Money is productive. Every dollar has the potential to generate more dollars. The only question is whether you are activating that potential or suppressing it. A savings account suppresses it. It is a vault. Vaults are useful, but you do not build wealth inside a vault. You build wealth by putting things to work. She pulls up a second comparison. 2 people, both start with $50,000 at age 30. Person A puts it in a high-yield savings account. 4.5% average return. After 30 years, $180,000. Person B puts it in an S&P 500 index fund. 10.1% average annual return, which is the historical average since 1957. After 30 years, $878,000. Same starting capital, same time horizon. No additional contributions in either case. The difference is not talent. It is not timing. It is not luck. It is the decision to deploy instead of store. You ask, but what about the risk? Renata says, tell me about the risk of watching $50,000 become $87,000 in real terms. That has a name too. The wealthy understand something that most people are never taught. Cash is not neutral. Cash is a liability. Not a liability in the accounting sense. A liability in the physical sense. It costs you something to hold it. It costs you inflation. It costs you opportunity. It costs you the compounding you didn't start. Every year you store money, instead of deploy it, you pay a fee. That fee is invisible. It does not appear on a statement. The bank will never tell you about it. This is not an accident. Savings accounts were designed for one primary beneficiary, the bank. When you deposit $100,000, the bank lends it at 7, 8, 9%. They pay you 0.46. They keep the spread. They have been doing this since the first savings institution opened in 1810. The model has not changed. It has only been refined. The bank is not your partner in this arrangement. You are the raw material. In the weeks after that meeting, you start reading. Not personal finance blogs. Primary sources, SEC filings, Federal Reserve data, Berkshire Hathaway shareholder letters from 1977 onward. You find a quote from a 1984 letter. Warren Buffett writes that he views cash as a perishable commodity, something that must be deployed or it loses value by definition. You read that sentence 3 times. You think about your $41,000 sitting in an account, generating a few dollars of interest each night while you sleep, and you understand for the first time that you have been confusing activity for progress. The number going up every month felt like proof. It was noise. Renata schedules a second session. This one is less structured. She wants you to understand the alternatives, not the concept of alternatives. The specific, real, available mechanisms that wealthy people use instead. The first is equity, not individual stocks, index funds. A total market index fund charges 0.03% in fees and delivers the compounding of the entire American economy over time. There is no savings account on earth that competes with that over any 2-0-year window in recorded history. Not one. You can look. The second is real estate, not flipping, not landlording in the traditional sense. Real estate as a vehicle for 3 simultaneous returns: rental income, appreciation, and leverage. A $400,000 property purchased with $80,000 down and $320,000 in debt still appreciates on the full $400,000. Your $80,000 earns the return of $400,000. A savings account cannot do that. A savings account does not know what leverage is. She says, leverage is not dangerous. Misused leverage is dangerous. The wealthy use it surgically. The third is dividend-generating assets, stocks in companies with long records of paying and growing dividends. The dividend aristocrats companies that have raised their dividend every year for 25 consecutive years include names like Johnson & Johnson, Procter & Gamble, Coca-Cola. They do not pay 4.6%. They pay 3 to 4% in cash, growing annually, plus price appreciation, plus the psychological effect of income that arrives whether markets are up or down. The fourth is private credit, not accessible at your level yet. But Renata walks you through it anyway, because she believes in building the full picture early. Private credit funds lend money to mid-sized businesses at 10 to 14% annually. The families she manages have allocations here. They are not waiting for a bank to offer them 4.6. They are the bank. This is the moment everything reorganizes in your head. The wealthy do not put money in savings accounts because they have become the bank. They have become the entity that lends, that owns, that collects. They have crossed to the other side of the transaction. You have been sitting on the wrong side your whole life. So has almost everyone you know. There is a moment in every financial education where the learner wants to find comfort in exception. You will think, but what about the emergency fund? What about liquidity? Surely even wealthy people keep some cash accessible? Yes, they do. Renata is direct about this. High-yield savings accounts and money market funds serve exactly one purpose for sophisticated wealth holders: temporary parking. Not a destination, a parking lot. You pull in, you figure out where you're going, you leave. The average American keeps 60% of their investable assets in cash or cash equivalents. The average allocation among ultra-high net worth families is under 5%. That gap is not caution. It is the difference between people who understand money and people who fear money and have confused the two. Fear looks like responsibility from the inside. From the outside, it looks like shrinkage. By the third meeting, Renata stops explaining things as concepts. She starts asking questions. She says, "What are you optimizing for?" You say, "Security." She says, "Security from what?" You say, "Losing what I have." She says, "You have $41,000. You are 31. If you do nothing exceptional, if you simply move that into a total market index fund and add $500 a month, you will have $1.4 million by age 65. If you keep it in savings and add the same $500 monthly, you will have $480,000. She lets that sit. Which one feels like losing what you have? This is the hardest part to explain. The savings account is not the enemy. The psychology behind it is. The savings account feels virtuous because it is passive. You put money in. You are disciplined. You watch it accumulate. You feel like you are doing something that requires nothing from you. That feeling, that comfortable, clean, responsible feeling, is exactly what the financial system has been designed to produce in people who are not meant to accumulate real wealth. Comfort is the mechanism of containment. The wealthy are not more disciplined than you. They are not smarter. They are not working harder. What they are is more uncomfortable. They know that money not moving is money decaying. They feel mild anxiety when cash sits idle for too long. That anxiety is not a flaw. It is a correctly calibrated response to reality. You have been trained to feel the opposite. You have been trained to feel safe when money stops moving. That training is expensive. You have been paying for it for years. The last thing Renata tells you is not about accounts or assets or percentages. She says, the shift isn't about the vehicle. It's about the verb. You ask what she means. She says, savers store, builders deploy. Those are not the same activity. They produce different results. They build different identities. They end up in different rooms. She closes the folder. She says, you're already in this room. That's not an accident. You leave. The elevator takes you back down to street level. Outside, the city is moving. Deliveries, meetings, lunch crowds, people who are working hard, saving carefully, watching their accounts with the same quiet pride you had 3 months ago. You think about the $41,000. Still sitting there. Still earning 4.6%. Still, in real terms, still losing ground while you stood still. You think about the $1.4 million on one side of the ledger and the $480,000 on the other. You think about the families Renata works for. Not because they took risks others were afraid to take. Not because they inherited advantage, though some did. But because someone, at some point, told them the truth about what a savings account actually is. Not a tool for building wealth. A tool for feeling like you're building wealth. The distinction is everything. The market's open tomorrow. Your account is still there. The only question left is what you're going to do with what you now know.